Today is Monday, February 9th, 2026. And if you're holding silver right now, physical bars, coins, mining positions, what I'm about to show you in the next 12 minutes will fundamentally alter how you see this market. Because something just shifted, not gradually, not theoretically, actually shifted. In the last 72 hours, 3 independent data points converged. And when I say independent, I mean they came from completely unrelated parts of the global system. Shanghai Futures markets, United States Treasury Department, the US Mint itself. 3 separate entities, 3 identical signals, all within 72 hours. And all of them are screaming the same thing. The physical silver market has entered a supply crisis that the price hasn't even begun to reflect yet. Right now, as I'm recording this, silver trades at $76.89 per ounce. That number alone doesn't tell you anything. But what happened between Friday evening and this morning, what the data is now confirming about the structure of this market, and what one of the most accurate commodity analysts in modern history just updated his timeline to reflect, that should absolutely get your attention. Because here's what just changed. The correction everyone said would kill this rally, it's over. It didn't weaken the structure, it reinforced it. And the analyst whose momentum work predicted the 1987 crash before it happened, whose signals caught the copper supercycle of the 2000s, whose framework identified the lead explosion that tripled prices in 18 months, he just issued an updated analysis. Michael Oliver. And his conclusion is unequivocal. Silver's structural breakout is now locked in. His minimum target, $500 per ounce. His timeline, this summer, 4 months from today. But here's why this is different from every other bullish silver prediction you've heard. We now have confirmation from 3 completely separate sources that all landed within the last 72 hours. Market behavior, government action, physical supply data, and they're all pointing in the same direction. This isn't speculation anymore, this is pattern recognition. Same pattern, same sequence, same outcome. Let me show you exactly what happened this weekend and why it matters more than any price chart can tell you. Between Thursday evening and Monday morning, 3 things occurred. Individually, each one would be significant. Together, they represent something that hasn't happened in modern commodity markets. First, the Shanghai Futures Exchange reported weekend trading activity that saw silver briefly touch $98 per ounce in yuan-denominated contracts. Not a typo. While Western markets were closed, Chinese buyers were paying nearly $100 for physical delivery contracts. The premium over New York spot prices exceeded $20 per ounce. Think about what that reveals. When buyers in the world's largest manufacturing economy are willing to pay 25% premiums for immediate physical delivery, it's not market inefficiency. It's a screaming alarm that something has broken in the global distribution system. Regional supply is tight, tighter than Western traders see in their COMEX data, tighter than the spot price reflects. Second, over the weekend, the United States Treasury Department issued a memorandum, now public, classifying silver as a critical mineral essential to national security infrastructure. This isn't symbolic language. This is the exact same classification given to lithium, rare earth elements, cobalt, materials whose supply chains are now considered matters of national defense. Why does this matter? Because it means the US government has officially acknowledged what industrial data has been screaming for months. There is not enough silver available to meet demand from solar installations, AI data centers, electric vehicle manufacturing, and defense applications. When governments start classifying commodities as strategic assets, prices don't stay suppressed. They explode. Because suddenly it's not about market forces anymore, it's about national security. And national security doesn't negotiate on price. Third, and this is the piece that dropped today, the US Mint announced it is suspending American Silver Eagle production for the remainder of February due to planche supply constraints. Planches are the blank metal discs that get stamped into coins. The official United States Mint, with direct access to domestic refiners, with global supply chain connections, with the full backing of the Treasury Department, cannot source enough physical silver to maintain production. This is unprecedented. The last time the Mint suspended Eagle production was briefly in 1999 during Y2K hoarding panic. We're not in a panic right now. We're in February 2026. It's a normal month, and they can't get metal. Now here's where this gets critical. Each of these data points arrived independently. The Shanghai premium wasn't coordinated with the Treasury classification. The Treasury memo wasn't timed with the Mint suspension. These emerged from completely different parts of the global silver system within 72 hours of each other. When multiple unrelated indicators all flash the same signal simultaneously, that's not coincidence. That's confirmation. Mathematical certainty. The physical silver market has entered a new reality, and the price hasn't caught up yet, not even close. Let me show you what happened during the recent correction and why everyone who panicked completely misread what was actually occurring beneath the surface. Between late January and early February, silver experienced what traditional analysts called a violent correction. From peak to trough, the metal fell approximately 18% in just 9 trading days. Social media exploded. The rally is finished. It's over. Silver always does this. The manipulation is back. Technical traders pointed to overbought indicators as proof the move had gone too far too fast. Retail investors who bought at $85, hoping for $100, panicked and sold into the decline. You saw the posts everywhere. I knew this was too good to be true. But here's what those sellers missed. And it's the difference between making life-changing returns and getting shaken out right before the biggest move. Michael Oliver's momentum structural analysis doesn't look at price the way conventional traders do. He uses an analogy that makes this crystal clear. Watching price charts, he says, is like watching your car's speedometer. It tells you how fast you're currently going. But it reveals absolutely nothing about the engine's power, the fuel in your tank, or whether you're about to accelerate or slam the brakes. Momentum analysis examines the engine itself. It measures the underlying force driving price movements across multiple time frames. Daily momentum, weekly momentum, monthly momentum, annual momentum. When all of these start moving in the same direction after years of divergence, it signals something massive is building underneath the surface. During the recent correction, here's what happened to silver's price. It fell from roughly $87 to $71, an 18% decline that looked absolutely brutal on any price chart. Devastating if you were watching your portfolio value. But here's what happened to the momentum indicators Oliver tracks. They barely budged. The weekly momentum structure remained in bullish territory throughout the entire sell-off. The monthly momentum actually strengthened during the decline as structural buyers absorbed every wave of panic selling. And the annual momentum, the longest time frame signal, never even flickered. This behavior reveals who the dominant market participants are right now. Short-term speculators, the traders using leverage, playing for quick profits, they exited during the correction. They're the ones who drove the price down sharply when volatility struck. But structural buyers, the industrial manufacturers who need physical metal for production, institutional funds building long-term positions, the sovereign wealth funds accumulating strategic reserves, they viewed the decline as a gift, and they absorbed every ounce that weak hands were dumping. When structural buyers can soak up an 18% correction in 9 days, not 9 weeks, not 9 months, 9 days, it tells you the market's character has fundamentally changed. This isn't the silver market of 2020 or 2015 or 2011. This is a market where real deep-pocketed long-term buyers are waiting for any dip to add size. Oliver describes what we just witnessed as structural reinforcement. Think of it like a building under construction. Before you can add additional floors, you need to pour a stronger foundation. The recent sell-off was that foundation building process. The price fell, yes, but the market's internal architecture never broke down, never even cracked. And here's the critical piece. Within 10 trading sessions, silver had recovered the entire decline. The snapback wasn't gradual. It wasn't tentative. It was immediate and powerful. That is not the behavior of a market that's topping out. That's the behavior of a market that's coiling to explode higher. In Oliver's 40 years of analyzing commodity cycles, he's seen this exact pattern before major bull market accelerations. He saw it in copper before its massive run in the 2000s. He saw it in lead before it tripled in 18 months. And he's seeing it now in silver, but with momentum readings that suggest a move larger than either of those historical precedents. The correction didn't damage silver's trajectory, it validated it. And if you sold into that decline, what just changed today should make you reconsider your position immediately. Because the acceleration phase that follows this type of structural reinforcement, that's where the most dramatic gains occur. And we're entering that phase right now, not in 6 months, not next year, right now. Let me explain why Oliver's $500 target isn't a random number pulled from imagination, and why his methodology has earned him credibility with some of the largest commodity funds in the world. Most technical analysts look at price charts and try to identify support levels, resistance zones, moving averages, trend channels. When their indicators show overbought conditions, they reduce positions or exit entirely. This is the conventional approach taught in every trading course. Oliver argues this methodology is fundamentally flawed during structural market transformations. And here's why. Price-based technical analysis works reasonably well during normal cyclical markets. When an asset oscillates within a defined range, support and resistance levels have meaning. Overbought indicators successfully identify short-term tops. But during structural breakouts, when an asset is shattering multi-decade resistance levels and entering entirely new price territory, conventional indicators become worse than useless. They become actively misleading. They tell you to sell right before the biggest moves happen. Silver has been structurally suppressed for over 40 years. Since 1980, the metal has been trapped in a massive base pattern, unable to sustain moves above $50 for more than brief periods. This suppression occurred despite growing industrial demand, despite inflation, despite multiple monetary crises, despite everything that should have driven prices higher. Oliver's momentum work shows that the ceiling containing silver for 4 decades has now been shattered. This isn't a minor technical breakout that might reverse in a few weeks. This is a multi-generational resistance level being destroyed. And when that happens, price doesn't simply drift higher in an orderly fashion. It gaps violently upward to reach levels it should have hit years ago if not for artificial suppression. He calls this phenomenon lightning form repricing. Decades of pent-up pressure releasing in compressed time. It's not gradual, it's not polite, it's explosive. And you can't unsee it once you understand the pattern. Let me give you the mathematical framework behind his $500 minimum target, because this is where it stops being speculation and starts being structural analysis based on observable market mechanics. One of the most powerful dynamics supporting extreme silver targets is the relationship between gold and silver, measured through what analysts call the gold-silver ratio. This ratio is simple. It tells you how many ounces of silver are required to buy 1 ounce of gold. Right now, with gold trading at 46.66 and silver at 76.89, that ratio sits at approximately 64.6 to 1. Historically, over centuries of data, this ratio averages around 50 to 1. But here's what's critical. During precious metals, bull markets, the ratio doesn't just drift toward its average, it crashes dramatically. In 1980, at the peak of the last major silver mania, the ratio fell to 15 to 1. In 2011, during silver's run to $49, the ratio compressed to 31 to 1. These aren't statistical anomalies. They're the normal behavior of silver during bull market acceleration phases. Why does this happen? Basic mathematics of market capitalization. The entire global silver market, all the metal available for investment, is worth roughly $1.4 trillion at current prices. The gold market is worth approximately $15 trillion. Gold is more than 10 times larger. When capital flows into precious metals during monetary crises or inflation fears, that money has to go somewhere. If $100 billion flows into the gold market, it might push prices up 6 or 7%. But if that same $100 billion flows into silver, it has to push prices up 70 or 80% just to absorb the capital. This is leverage, not financial leverage. Mathematical leverage based on market size differentials. And it's unavoidable. It's structural. Oliver's technical work shows that a critical resistance level in silver's performance relative to gold has just been breached. This exact pattern appeared before the 1979 to 1980 explosion when silver rose nearly 5 times in 5 months. It appeared again before the 2010 to 2011 rally when silver more than doubled in 7 months. Now it's happened a third time. Same pattern, same sequence. But according to Oliver's analysis, the structural base supporting this breakout is wider and stronger than either historical precedent, which suggests the potential for an even larger percentage move. Let's run the mathematics on what this means for actual price targets. If gold reaches $8,000 per ounce, which would simply match historical bull market multiples from its current base, and the gold-silver ratio compresses to just 20 to 1, nowhere near the 15 to 1 extreme seen in 1980, silver would trade at $400 per ounce. If gold hits $10,000, which several mainstream analysts now consider possible, given global debt levels and currency debasement, and the ratio compresses to 20 to 1, silver reaches $500. Oliver's minimum target of $500 implies either gold reaching $10,000 with moderate ratio compression, or gold at $8,000 with more aggressive compression to 16 to 1. Both scenarios have clear historical precedent. These aren't fantasy numbers. They're mathematical projections based on observable market mechanics that have played out multiple times in modern history. The real question isn't whether such moves are possible. History proves they are. The question is whether the structural conditions exist right now to trigger them. And this is where what changed today becomes absolutely critical, because we're not looking at theory anymore, we're looking at confirmation. While Oliver's technical analysis provides the timing and price framework, there's an equally compelling fundamental story that most investors are completely missing. And what happened today with the mint suspension just confirmed it. For 5 consecutive years, global silver consumption has exceeded production. We're running a structural deficit of approximately 200 million ounces every single year. And this gap isn't closing, it's widening. Let me break down why. Because this is the fundamental force that will eventually make Oliver's technical targets look conservative. First, industrial demand is exploding in sectors where silver cannot be substituted. Solar panel manufacturing requires silver's unique conductive properties. There is no economically viable alternative at scale. With global solar installation capacity expanding at unprecedented rates, particularly in China, which produces 85% of the world's panels, this single sector is consuming over 150 million ounces annually, and that number is growing 20% per year. Every year, 20% growth in a sector that already consumes 150 million ounces. Artificial intelligence infrastructure is driving construction of massive data centers globally. These facilities require sophisticated electrical systems where silver plays a critical role in connections, switches, thermal management. Every major tech company, Microsoft, Google, Amazon, Meta, is racing to build AI computing capacity. Each new data center requires thousands of ounces of silver. This demand didn't exist 5 years ago. Now it's accelerating exponentially. Electric vehicle production uses significantly more silver than traditional cars. A standard gasoline vehicle contains roughly half an ounce of silver. An electric vehicle contains between 1 and 2 ounces, mostly in battery management systems and power electronics. As global automotive fleets electrify, this demand vector continues climbing. Medical devices, smartphones, 5G infrastructure, military applications, all require silver. This is non-discretionary industrial consumption that cannot be easily reduced or substituted. Now here's the other side of the equation. Supply cannot respond quickly enough to meet this surge. Mining isn't like turning on a faucet, discovering a new silver deposit, securing environmental permits, raising capital, building infrastructure. Bringing a mine into production requires 10 to 15 years minimum. And here's the problem. Years of suppressed silver prices when the metal traded in the $15 to $25 range throughout the 2010s discouraged the massive capital investment needed for new projects. The mining companies that exist today are mostly depleting their highest grade ore bodies. The easy, rich silver deposits were found and mined decades ago. What remains requires processing more rock to extract less metal. Production costs are rising, not falling. Recycling helps, but it cannot bridge a 200 million ounce annual deficit. Most industrial silver is used in such small quantities per application that it's not economically recoverable. The silver in your smartphone is worth maybe $2. No one is recycling it. The silver in a solar panel is worth maybe $10. It's not getting recovered. This is the setup for what Oliver calls lightning form repricing. When markets ignore fundamental deficits for extended periods, the eventual price adjustment doesn't happen gradually. It happens violently as price catches up to reality all at once. The deficit was building quietly while silver traded at $20, $25, $30 per ounce. Structural buyers were getting metal cheap. And now, with silver above $75, the deficit still exists. The price has risen, yes, but it hasn't risen nearly enough to actually balance supply and demand. What happens when industrial buyers, who must have physical silver to maintain production, start competing with investment demand? What happens when sovereign wealth funds decide they need strategic reserves? What happens when the COMEX exchange, which has been running on a fractional reserve system for years, faces an actual delivery squeeze? We may be about to find out, because what just changed today suggests we're moving from theoretical deficit to actual physical shortage. Let me give you concrete evidence from just the past few weeks that validates what Oliver's momentum analysis is indicating. These aren't predictions. These are documented market events happening in real time. COMEX, the major commodities exchange, reported delivery notices in January that were 3 times higher than January of last year. 3 times. This signals intense demand for physical metal, not just paper speculation by traders rolling contracts. The exchange introduced a new 100-ounce silver futures contract specifically to meet what they described as record retail demand. Think about that. The exchange itself is acknowledging unprecedented interest from smaller investors, and they're creating new products to handle the volume. Margin requirements at COMEX were increased from fixed dollar amounts to 9% of notional value. This is the exchange preparing its infrastructure for much higher price levels and volatility. They don't make these changes casually. They're expecting violent moves. In China, as I mentioned, the Shanghai Futures Exchange saw silver prices approach $100 per ounce at points this weekend. That's a $20 premium over Western spot prices. This reveals regional supply tightness that New York and London traders aren't fully pricing in yet. The U.S. Mint, as we discussed, just suspended Silver Eagle production. When they did release the 2026 Eagles before the suspension, they sold out in hours, not days, hours. Retail dealers like APMEX saw premiums for bulk purchases of American Silver Eagles touch $9 to $9.50 per coin at points last week. That's a $20 premium over spot price. When premiums expand to those levels, it signals physical shortage conditions developing in retail distribution. Perhaps most significantly, and this ties directly to what changed today, the Treasury Department's classification of silver as a critical strategic mineral wasn't done in isolation. It followed a series of high-level meetings between the Treasury, the Department of Defense, and major silver-consuming industries. According to sources familiar with the discussions, defense contractors informed the government they're facing supply constraints for silver needed in missile guidance systems, radar equipment, advanced electronics. This is national security infrastructure that cannot be delayed or substituted. When the United States government starts treating silver as a strategic resource with defense implications, the playbook changes completely. We've seen this with rare earth elements, with lithium, with semiconductor materials. Once something gets classified as critical to national security, price becomes secondary to supply security. These market behaviors, the COMEX delivery surge, the exchange infrastructure changes, the mint suspension, the Shanghai premiums, the government classification, they're all flashing the same signal. The physical silver market is tighter than the paper price suggests. And here's what should concern anyone watching from the sidelines. Once a physical shortage becomes obvious to mainstream investors, once it makes financial news headlines, the scramble for metal will make the current $77 price look like ancient history. Beyond silver's individual supply-demand dynamics, there's a broader monetary shift occurring that amplifies the entire precious metals thesis. And what changed in the last 72 hours is that this shift just accelerated. Last Friday, Japan's central bank announced an emergency bond buying program to prevent government bond yields from spiking above 2%. Think about what that means. The Bank of Japan is explicitly printing currency to prevent their own government's borrowing costs from rising to levels that would make their debt mathematically unsustainable. Japan isn't alone. The United States is running trillion-dollar deficits with no plan to reduce them. The UK just announced they're extending their quantitative easing program indefinitely. The European Central Bank is facing pressure to restart large-scale asset purchases. This is the reality. Major economies have debt levels that cannot be serviced at normal interest rates. So central banks face an impossible choice. Let rates rise and trigger economic collapse, or intervene by creating massive amounts of new currency. They're choosing intervention every single time. And intervention means currency debasement on a scale we've never witnessed in peacetime. In this environment, investors seek assets that exist outside the debt-based financial system. Physical commodities with thousands of years of monetary history become the only safe harbor when fiat currencies are being deliberately devalued. We're already seeing this dynamic unfold. Central banks globally have been accumulating gold at record levels for 3 consecutive years. Why? Because they understand the monetary endgame better than anyone. They're the ones implementing the currency debasement. Of course they're buying hard assets. They know what's coming. Oliver's analysis suggests we're entering a commodity supercycle similar to the 1970s, but amplified by factors that didn't exist 5 decades ago. In the 1970s, there was no solar industry consuming 150 million ounces of silver annually. There was no electric vehicle revolution. There was no AI infrastructure build-out. The industrial demand drivers we have today simply didn't exist. The monetary crisis is also more severe. U.S. federal debt in 1970 was roughly $370 billion. Today, it's $36 trillion and climbing. The debt to GDP ratio has gone from 35% to over 125%. The scale of currency creation required to manage this debt makes the 1970s look modest by comparison. When capital flows from financial assets into tangible stores of value accelerate, and Oliver believes we're in the early stages of that acceleration right now, it creates enormous upward pressure on precious metals prices. His gold target of $8,000 isn't speculation. It's historical bull market multiples applied to current structural conditions. Gold traded at $35 in 1970 and hit $850 by 1980. That's a 24 times move. Applied to gold's 2020 base of $2,000, a similar multiple would put gold above $28,000. Oliver's $8,000 target is actually conservative by historical standards. And if gold reaches $8,000, the mathematical implications for silver through ratio compression are staggering. We're not talking about silver doubling or tripling from here. We're talking about potential 5 times to 8 times moves over the next 12 to 18 months. What changed today with Japan's emergency intervention, with the Treasury silver classification, with the mint suspension, is that this timeline may be compressing faster than even Oliver anticipated. Now, if you're holding physical silver, what I've outlined so far should reinforce your conviction. But if you want to understand where the most explosive returns could occur during this cycle, you need to understand the leverage dynamics of junior mining companies. Oliver specifically highlights junior miners as presenting what he calls the greatest opportunity. And he uses the word especially when discussing them. This isn't casual commentary. It's a deliberate signal about where he sees the most dramatic returns. Let me show you the mathematics. A mining company producing silver at an all-in cost of $20 per ounce, selling it at today's $77 market, makes $57 profit per ounce. If that company produces 5 million ounces annually, that's $285 million in annual profit. Now, if silver rises to $300 per ounce, that same miner with the same production is now making $280 profit per ounce. On 5 million ounces, that's $1.4 billion in annual profit. profits haven't increased by a factor of 4. They've increased by a factor of nearly 5. But here's where it gets truly interesting. Mining company stock prices don't just move in line with profit increases. They typically move 3 to 5 times the underlying profit expansion due to multiple expansion. Investors pay higher price-to-earnings multiples during bull markets, so a 5-fold profit increase could drive share prices 15 to 25 times higher. In reality, during mania phases, the multiple expansion can be even more extreme. This leverage effect has been demonstrated repeatedly throughout history. During the uranium boom of the early 2000s, uranium prices rose 7-fold from $10 to $70 per pound. The best-positioned junior uranium miners saw gains exceeding 50 times their base valuations. Stocks went from 50 cents to $25, from $2 to $100. In the lithium explosion that peaked in 2022, lithium carbonate prices increased 13 times. The best junior lithium miners saw gains exceeding 100 times. Companies went from micro-cap explorers to multi-billion-dollar producers in under 3 years. Oliver's emphasis on junior miners isn't casual. It's a deliberate signal. If the silver thesis plays out, if we see $300, $400, $500 silver over the next 12 to 24 months, the mining company's positioned to capture that profit explosion will generate returns that make the metal itself look boring by comparison. But, and this is absolutely critical, selectivity matters enormously. Not all mining companies are created equal. Some have hedged their production, capping their upside. Some operate in politically unstable jurisdictions where nationalization risk is real. Some have incompetent management teams that will squander the opportunity even in a raging bull market. The opportunities lie with unhedged producers in stable jurisdictions like Canada, the United States, Australia, companies with competent management, strong balance sheets, quality assets in proven districts with expansion potential. These are high-risk, high-reward investments, suitable only for the aggressive portion of a portfolio. But for investors who can tolerate extreme volatility and have conviction in the underlying silver thesis, the potential returns are extraordinary. What changed today that makes this moment so sensitive? The smart money has started to move. Major mining companies, the senior producers, are now acquiring junior miners with quality deposits. And that kind of consolidation doesn't happen by accident. When the biggest players begin buying assets instead of exploring for them, it signals that they see higher prices ahead and want to secure supply before the next phase begins. Historically, this is how every major bull market starts accelerating. If you wait until silver is $150 or $200 before looking at junior miners, you'll already be too late because mining stocks move ahead of the metal itself. They always lead. By the time silver hits peak prices and makes headlines, the biggest percentage gains have already happened. But before rushing in, there's a hard truth you need to accept. This market will be extremely volatile. Even powerful bull markets don't go straight up. Legendary resource investor Rick Rule often points out that during the 1970s gold run, when prices ultimately exploded higher, there was still a brutal 50% correction in the middle of the advance. Imagine watching half your gains disappear after feeling certain you were right. Many investors sold in fear during that drop and missed the massive move that followed. That's how bull markets work. They shake people out before the real surge begins. Silver will likely experience similar corrections of 25 to 30% or more. Not maybe, it will. We just saw an 18% pullback that scared a lot of traders, and it reversed in days. The next one could last longer and feel worse, and your ability to stay calm through it will determine whether you capture the full upside or get pushed out early. These corrections aren't flaws in the thesis. They're part of the process. They reset sentiment, remove speculation, and create opportunities for patient investors. That's why position sizing matters so much. You should never invest money you might need soon. You should never overextend emotionally or financially. Volatility isn't a bug, it's a feature. It's what separates disciplined investors from those who constantly buy high and sell low. Right now, we've just come through a correction, the market has stabilized, and confidence is slowly returning. Ironically, this is often when the next major move begins. If you already hold physical silver, the recent developments simply reinforce the broader structural story: tightening supply, rising industrial demand, and growing institutional interest. Your job isn't to trade every swing, it's to hold steady. If you own mining stocks, expect even bigger swings, because they rise faster and fall harder than the metal itself. That leverage cuts both ways. And if you're still on the sidelines, understand that the early stage of a bull market offers the best risk reward. Once silver breaks decisively higher and mainstream media starts talking about shortages, you won't be early anymore. You'll be chasing. The smarter approach is to make a plan now, allocate only what you can afford to leave untouched for the next year or two, and split between physical silver for stability and carefully chosen miners for upside. Then have the discipline to do nothing and let the bigger trend work. Markets don't reward comfort or perfect timing. They reward conviction and patience. The large players are already positioning. The only real question is whether you'll be ready before the window closes.